Hi, my name is Brenton Harrison, and we're here today to break down the difference between two different financial concepts. One, margin trading, and the other, securities-backed lending, with a particular emphasis on something called a securities-backed line of credit. Let's get started. To me, one of the best and worst things that's happened in the past, I'd say 10 years or so when it comes to finance, is the increasing availability and access to investing tools when it talks about the general public. I came into this business in 2009, and I remember at that time, even something as simple as buying a stock, a person would have to call me. I would help call the brokerage agency and we would place that trade, and really every person along the way, absent the consumer, would get paid just a little bit for that transaction. Well, now you have things like Webull and Robinhood, where laypersons can go and they can buy shares of stock, they can buy mutual funds, they can buy index funds and ETFs from their phone. You know, they can round up the next dollar purchase to make sure that those spare few cents goes into their purchase. You have services like Wealthfront and Betterment that offer automated investing, where as long as you have an idea of your risk tolerance as an investor, which is something we've covered in past videos, they'll make the investment decisions for you. They've made it increasingly easy for an average consumer who's not a person in financial services to have access to these tools. And there's a good part of that, which is, hey, you should democratize this process a little bit, but there's a bad part to it as well. And that bad part is that it has given access to some things that are very risky without forcing people to have the background, experience, and knowledge to know whether it's something they should take advantage of or something that should be left on the shelf. It's inevitable that over these past few years, you've heard people going on and on about things like Forex trading, or you've heard people talk about options trading, which is, for a person who's financially stable enough to pursue it, a potentially fantastic investment choice when appropriate. You've heard about things like meme stocks with GameStop and AMC and all these people who were becoming overnight millionaires. And in many of these cases, the way the funding mechanism that people were taking advantage of these opportunities came through something called margin trading. So margin trading is a form of debt financing where that brokerage company is giving you money, and it's not necessarily based on how much you already have. They're giving you fresh money that you can use to go buy securities in that same account. But there is a form of financing available where they base the amount you can borrow on the amount you actually have, and that is called securities-backed lending. And today we're going to talk about a particular form of securities-backed lending called a securities-backed line of credit, or you might commonly hear it referred to as an S block, or there are others who call it a portfolio line of credit. And to be clear, all form of debt has its risks, and S blocks and securities-backed lending, it has its risks as well, but it works very, very differently from margin trading, starting with the fact that unlike margin trading, if you're trying to do an S block, it's based on a percentage of the amount of money you already have invested with a particular brokerage company. And these are becoming increasingly more popular amongst a crowd of people who didn't have access to them before. I would say most brokerage companies have a certain threshold where when you reach that threshold, you make yourself eligible to apply for a securities-backed line of credit. And as a matter of fact, some of those robo-advisors we talked about, like Wealthfront and Betterment, once you reach that threshold, they automatically open up this S block for you, and you don't even have to apply. So what I wanted to do today is I wanted to go through the pros and cons of securities-backed lending, but I also wanted to compare it to margin trading so you can see the difference between these two forms of financing. Let's start by explaining the concept of collateral. If you borrow money from a person or a company, in most cases, while you have borrowed that money until you've paid it back, they're going to want you to put up something as collateral. They're going to say, hey, we'll give you this money over here, but you have to give us something of equal or more value while we're waiting for you to pay us back. In this scenario, you have pledged that piece of property or that investment account in this scenario as collateral. And if you do not pay back the loan that you took, the person that that gave you the money simply keeps whatever it was you gave them. Let's look at a scenario of a person who needs to borrow $20,000 from a friend. The friend needs assurances that they'll be okay if for some reason you can't give them back the money that they loaned. So they ask to hold on to your watch that is worth the $20,000 that you borrowed. It is of equal value to the funds that they gave you as a loan. Now, as long as they have the watch, they're really not worried, or they're not as worried about the money they loaned to you, because if you don't pay them back, worst comes to worst, they can simply sell the watch you gave them as collateral and get their $20,000 back. Now, it's worth noting that a watch is an asset that in many cases will appreciate in value over time, or at minimum, its value will be static. It will remain the same. Now, the likely increase in value, it also reduces your friend's risk that if you don't pay them back, they might be left with a watch that's worth less than what they loaned you. But not all assets used as collateral will increase in value, and some even decrease. And the greater the risk of that collateral decreasing in value, the more of a buffer, or in this case, it's called a margin, the lender will want between the value of collateral and what they offer to you as a loan. And I'm going to show you this in an example where we're going to assume that we have a friend who's willing to lend you some money, and they're going to use baseball cards as collateral. You have a collection of baseball cards. You want $20,000 from them or a certain amount of money from them, and they say, hey, give us those baseball cards as collateral. Now, these baseball cards are currently worth $20,000, but you and your friend, they know, and you know, that the value of a collectible like baseball cards can change drastically over the years. Matter of fact, it's basically in the eye of the beholder. So it's not going to necessarily increase in terms of a guarantee. It may not even remain static. In some cases, the value of these cards could decrease. So let's look at how the friend protects themselves in this scenario. What they do is, even though the cards are currently worth $20,000, the friend decides they want to protect themselves a little bit in case these cards drop in value. So they say that they're going to loan you 75% of the card's value, or $15,000. Now, if the value decreases slightly, they're still holding that collateral that's worth more than the outstanding loan. And in investment terminology, this remaining 25% buffer between the loan amount and the card's value is called the margin. That's what it is. You can call it a buffer, but in investment terminology, it's called a margin. And if we extend this scenario out a little further, what do you think would happen if for some reason you came to your friend before you paid them back and you said, I need some of those baseball cards. I know I gave them to you as collateral, but I need to take them back. Well, now your friend doesn't have the buffer that they needed between what they loaned you and the value of collateral. So if you come and take some of those cards, some of what you pledged as collateral, your friend is going to tell you, hey, either pay me back some of the money that you borrowed so I can get back within my dedicated or preferred margin, or you need to give me some more baseball cards to increase the value of the collateral that they're holding. No, not at all. And there's a big reason that I'm going to go through painstaking links, and I'm starting really low when it talks about how complex these concepts are getting, because I want to make sure you understand the difference between collateral and what margin trading is. Margin trading is when a person who has a brokerage account goes and borrows money that's not based on the value of the money in that account, and they use that money to buy securities within that same account, which you actually can't do with a securities-backed line of credit. You can't take money from a securities-backed line of credit and put it back into the account that you've pledged as collateral. That's commingling the collateral with what you're trying to accomplish with the money that you borrowed. With margin trading, you can. The very purpose of it is to take money that you don't have and use it to buy securities within that same account. But securities-backed lending works very differently. And just in case you're a visual person like myself, let's go through an example of what margin trading looks like on paper. If we have an account owner that has $5,000 in their brokerage account and they want to buy 75 shares of an investment that's currently trading at $100 per share, in this scenario, they would be $2,500 short. So they wouldn't be able to purchase 75 shares. They'd be stuck at 50 shares. So what they can do if they really want those additional shares is they can take a margin loan from the brokerage for $2,500 and they can use that loan to buy those additional 25 shares. So now let's look at the scenario of them increasing in value. If those 75 shares, which were worth $100 per share when they were purchased, increase in value to $150 a share, the account owner can sell basically 17 shares and they can use the proceeds from the sale to repay that $2,500 margin loan, and they can pocket the rest of the profits, which in this case is $8,750. But let's switch the scenario and let's assume that the value of the price per share, instead of increasing, it just collapses. And this can happen when you're dealing with individual companies because that's a greater risk when you're putting your money on the backs of one company. So let's say that they crash and their value goes all the way down to $20. Well, now those 75 shares, which represents their entire account balance, are worth $1,500. But guess how much they still owe on their loan? They still owe the $2,500. If you're following with me, you now understand it is possible in margin trading to lose more money than you actually have at your disposal. It's not as simple as, oh, well, I only started with $2,500 or $5,000, so that should be the limit of what I can lose. No, when margin trading occurs, depending on what you've done in that transaction, there is an unlimited potential loss. And that is a big difference between securities-backed line of credit. And it's why I gave you the scenario with the playing cards, where I said, hey, if you reach a point with those playing cards where you go and get some of that collateral, and now your lender is saying, we don't have our guaranteed margin that we prefer, they will simply say, hey, you either got to pay us back some of that money that you initially borrowed from us, or you got to give us more collateral. But what they won't do is allow your losses to exceed what you have in your account. They've protected themselves by giving themselves that margin, but they also have protected you more so than what you find in margin trading by making sure that you can't cross over that buffer as well. This mechanism means that because of collateral, your potential loss is baked into the transaction, where with margin trading, you're out there on a ledge without as much protection, which would hopefully give you an idea of why I'm clearly not a fan of margin trading, whereas securities-backed lending, when appropriate, can be a good potential tool for an investor. So now that we understand the concepts of collateral and the concepts of margin trading and its potentially unlimited losses, let's get into the nitty-gritty of how these S blocks work in detail. If you understand the trading card scenario, you can substitute the securities that you would have in a brokerage account for the trading cards that you pledged as collateral, and that's basically the concept of a securities-backed line of credit. You have a certain amount of money that you have in an investment account, and you use that money as collateral to open up a line of credit with another lender. Now, that brokerage company might have their preferred lender that they use in-house, or you might be able to just go get a securities-backed line of credit at any bank, even if it's not the same bank or brokerage company where you hold the investment account. It's all based on just saying, hey, I have this asset over here. I want to pledge it as collateral so that I can open up a line of credit over here. Now, what you can't do, which to me is a protection, is you can't take money from the securities-backed line of credit and, as I said, put it back in the brokerage account and use it to buy securities, because now you're messing with the asset that you've pledged as collateral. But you also need to understand that when you use money on the line of credit, you still have the same money in your investment account. Using money over here does not impact the amount of money you have over here. So let's look at an example. If we have an investor who has a $100,000 investment balance in a brokerage account, we're going to assume that they go to either an in-house lender or even their personal bank and secure a securities-backed line of credit that's collateralized by that investment account for $50,000. Now, let's say that maybe a few months later, for whatever reason, they draw $35,000 from that securities-backed line of credit. You do not see your investment balance decreased by the $35,000 that they withdrew. This is not a withdrawal from a bank account. They are simply using that investment account as collateral. So when they borrow $35,000 on the securities-backed line of credit, it in no way impacts the value of the investment account. If you're looking at an investment account balance that you have and you're wondering how much you would have access to on a securities-backed line of credit, it's important that you understand that in the scenarios we've discussed about collateral, your lender wants to keep a certain margin or a certain buffer to have that level of comfort. So if you look at the investment account you're using as collateral, and let's say that you've invested it extremely aggressively, and because of that, you're seeing these big increases and decreases in the value of that collateralized investment, your lender is going to look at that and they're going to say, because of these big dips, it might come to pass that we want a certain buffer, and during a big downturn, the balance of this account goes within our level of comfort. So now we're at risk as a lender. So to give themselves some cushion, they may be really conservative and they might offer you a smaller percentage of that investment account balance as a securities-backed line of credit than they would if they looked at an investor whose investments were invested extremely conservatively. And now they know that those swings are going to be less pronounced. In that scenario, they would be able to go higher and be willing to go higher because they know that the odds of coming within their preferred margin have been reduced. Let's assume that we have a brokerage company who has an investment account owner with a balance of $100,000 and they've invested extremely conservatively. And in this scenario, this lender that they use for the securities-backed line of credit wants to make sure that they always have a margin between what the borrower has borrowed on their line of credit and what they have in their investment account of 40%. So in this scenario, that would mean that if that $100,000 were to stay still in terms of its value, then the lender would want to make sure that the borrower owes no more than $60,000 on this line of credit. Well, unfortunately, investment accounts don't stay still. They either go up in value or they go down in value. So the lender has to make sure that they prepare for the scenario that the borrower would have maxed out that line of credit at the same time that the investment account were to decrease in value. So they're going to look at the range of returns based on how this investment is invested. And they're going to say, hey, in a typical market, we think the range of returns in this account are between $90,000 and $110,000. So they might offer a securities-backed line of credit of $50,000. And the reason that they would do that is in the scenario where on the low end of returns, that investment account goes down to a balance of $90,000. If at that same time, our borrower had maxed out that line of credit and had taken the entire $50,000 they have available, the lender would still have their required minimum margin. As a matter of fact, they would have a 45% margin, which is more than enough to make sure they feel comfortable. This is what I'm talking about in terms of, hey, how aggressive or conservative you are, but it's also something we need to address in terms of how lines of credit work in the first place. And we've talked about this in the past when we've talked about home equity lines of credit, but I just say this to make sure we're driving home these points. The amount that you owe on the line of credit is not $50,000 simply because you have a $50,000 line of credit available. It just means that's what you have available. But if you only borrow $5,000, then you only owe $5,000. But the lender wants to make sure they protect themselves in case you max out that line of credit at the same time that they experience a downturn in the market. Now, conversely, let's say that we have a person who has an investment account balance of $100,000, but they've invested it extremely aggressively. And now that range of returns is much more volatile. Instead of $90,000 to $110,000, the potential range of returns are $80,000 to $120,000. Well, this means that if that lender were to have a securities-backed line of credit that they extended of $50,000 and that person maxed out the line of credit at the same time that the investment account balance experienced a loss in returns and had a $50,000 line of credit compared to an $80,000 investment account balance, they would now have a margin of only 37%. And this did not meet the minimum requirement or the minimum buffer that that lender had put in place. So as a result of this, they would not offer the $50,000 line of credit. They would offer a lower amount to protect themselves in the event that the borrower maxed out the line of credit at the same time that the investment account balance experienced an extreme downturn. Securities-backed line of credit are a really flexible option when appropriate for a number of different reasons. The first reason is that they don't always impact credit utilization. So we've talked about FICO credit scores ad nauseum on this channel, and we've covered the different scenarios. 35% of your score is payment history. Do you pay your bills on time? 15% is the age of your accounts. The older the average age of your lines of credit, the better. 10% is credit inquiries. How many people are checking your score in a given period of time? 10% is the blend of your different types of credit. But 30%, the second largest element of your credit score, is credit utilization. And credit utilization, as we've covered in the past, is a reflection of how much of your available revolving credit you have borrowed at a particular point in time. So there's two different types of debt and credit. There is installment debt. And installment debt is the type of debt where you get it and you can use it one time and you have to pay it back in a definitive period of time. That would be an example of things like a student loan, a car loan, a home loan. You get the money for the loan, you get it one time, you have to pay it back within a period of time. Installment debt is not reflected on your credit utilization for your credit score. What is reflected is revolving debt. Revolving debt are things like lines of credit. They're things like credit cards where you have a certain amount available to you. You can borrow it, you can pay it back, and then you can borrow it again. You can pay it back and you can borrow it again. It is an amount of money made available to you on a continuous basis, and you never have to actually pay it off in full. You can owe it forever. Well, as we said, credit cards are revolving debt and they show up on your credit score when it comes to credit utilization. But things like a home equity line of credit, which is revolving debt, and a securities-backed line of credit do not show up on credit utilization. And this is because they are not only revolving debt, but they are also secured by something. You put up collateral. With credit cards, there is no collateral. They give you the card, you can borrow it over and over and over again, but if you don't pay them back, it's not like they can take anything from you as it relates to the card. You put up no collateral. But with a home equity line of credit, you put up your home as collateral. With a securities-backed line of credit, you put up the securities and the investment account as collateral. And as such, even though it's revolving credit, it does not impact your credit utilization. So if you're looking at a way to finance something, you see people who are putting home repairs on things like credit cards or small business expenses on things like credit cards and then paying them back over time, well, that damages your credit utilization, but securities-backed line of credit do not. They do not impact this particular element of your credit score, and it gives you a well of resources that you can use without worrying about damaging your credit to the same degree. The second element that makes these an attractive option is that approval is really fast. And if you think about it, this makes sense. If you're going and you're trying to get a certain type of debt that's unsecured, well, now that lender is at real risk because if you don't pay them back, then they don't really have anything to seize from you. But in this scenario with the investment account, we talked about this with the trading cards. If for whatever reason you don't pay them back at all, they just take your investment account. If you get into a situation where you have less of a margin than is necessary, they will either make you add more money to the account or they'll make you pay back some of the loan. But the lender is pretty protected. And for that reason, approval for a securities-backed line of credit can occur in a week or two, whereas for even things like a home equity line of credit, that can take 6 to 8 weeks. A mortgage can take 2 to 3 months. There are other forms of debt financing that can take a similarly long period of time, like a small business loan. But with an S block, approval is typically really fast. The next benefit is that you have fast access to non-taxable funds. So if you were to take the same amount of money and actually withdraw it from the investment account, well, number one, you're losing some of the money in that account that you wanted to have in the market in the first place. You are depleting your reserves. You're depleting the amount of money that is going to work when you're not working. But you also, if there's been any gains in that account, would have to pay taxes on a percentage of those gains. So it's not as simple as just withdrawing the money. It's, hey, I withdrew the money. Now I have less there that would hopefully be growing at a rate of return. and I had to pay taxes on some of that money that I withdrew. Whereas with a securities-backed line of credit, you're using that investment account that you have as collateral, but you're not actually having to deplete it. And because you are technically taking a loan, you don't pay taxes on a loan, so you don't have to worry about capital gains taxes either. The next benefit is that payments on an S block are interest only. And this is a huge draw in terms of the pros for an S block. We'll talk about how it's also a con of an S block in a second. But when you have a securities-backed line of credit, unlike a car loan, unlike a mortgage where you have to pay the interest and the principal within a period of time, with an S block, you only are required to pay the interest. And that's significant because if you're using it to pay for things like an investment property or a small business where it might take a little bit of time for it to start generating revenue in terms of the end result of that investment for you to pay back the debt, you only have to pay the interest during that period. As an example, if you borrow $10,000 on a securities-backed line of credit and you're paying 6% interest, you're paying 6% interest for the year. So that's $600 for the year, and $50 a month would be your only required payment on that securities-backed line of credit. And as odd as this sounds, because the first part of this is that the payments are interest only, the next part of it is that they can be interest only as long as you have the investment account open. Unlike even a home equity line of credit, which might give you access to it for 5 years or 10 years before you have to repay whatever it is that you borrowed in full, as long as you have that investment account that's being used as collateral, you actually never have to pay back what you've borrowed on a securities-backed line of credit. You can owe it forever and just keep making interest-only payments forever. There are no restrictions on how a securities-backed line of credit can be used. If you look at the interest rate that you would pay on a securities-backed line of credit, it's typically going to be more competitive than what you would find on, in some cases, things like a car loan, but definitely more competitive than things that you see like a credit card. So it's not uncommon to see people who, instead of using credit cards, will use a securities-backed line of credit, or instead of getting a car loan, which will impact their credit in a major way, they might instead buy a car if they have enough in their collateralized investment account to have a line of credit with enough money in it to buy a car. That's something that you'll see for people with smaller lines of credit. You'll even see people who will use it, that securities-backed line of credit, as a down payment on an investment property. Hey, I'm looking at an investment property that's $300,000. I need $60,000 to make the down payment. Rather than pulling it from an asset or an investment somewhere, why don't I use $60,000 from my securities-backed line of credit to put it down as the down payment on my new investment property? And then I can have the tenants that I put in that property pay back the $60,000 that I borrowed, and I can do it all over again with another house. We'll have a video later and a podcast later, more on that to come in a bit, where we talk about that concept, because you even see people who will buy an entire house with the proceeds of a securities-backed line of credit. So they have no mortgage on the property, and it gives them a leg up in the home buying process. And then after they've secured the property, they'll put a mortgage on it later to replenish what they have on their securities-backed line of credit. So we'll talk about that more advanced concept in a future video. But the point is, the overarching point is that you can use these tools for a number of different uses. It's not all peaches and cream when it comes to S blocks. There are some drawbacks that you need to consider. And the first is that your investments can be forcibly traded if you come within that dedicated buffer zone or margin that your lender requires. We talked about this in the trading card scenario. I'm going back to that because I think it's an easier concept than putting securities in the mix. But in that scenario, if you went and you did not have that buffer that your lender required, they're going to make you either put more money or put more trading cards into that collateralized account, or they're going to say, give us back some of the money that you actually borrowed. So if you do not keep that margin, you could be forced to sell securities that you did not want to sell in order to get back within that margin, or you would have to make a lump sum payment on the securities-backed line of credit to get within that margin. Another consideration in terms of a con is if you're trying to keep that margin, we've really been talking about the scenario where you keep all your trading cards in the table. But if you do, like we discussed, take some trading cards out, or if you wanted to sell some of those securities in our more realistic example to go do something else with them, you may not be able to. It may put you in a position where, again, you're within that comfortable margin. So if you are planning to actually use these assets and you think you might need to sell them, it might not be a good idea to collateralize them and open an S block, because now you might be restricted as to how much you can actually sell. And then lastly, the payments in terms of the cons are interest only. And I know that I said that as a pro, but it can also be a con because it can put you in a scenario where you stop doing as much due diligence as to the reason that you would take money out from that securities-backed line of credit. If I can take $10,000 out in another form of debt and maybe my payment on that is $400 a month versus taking $10,000 out on a securities-backed line of credit and my payment is $50 a month, I may not do the due diligence to make sure that I'm accessing that $10,000 for a good reason. Or I may not use it to do things that are actually going to save me money or going to increase in value. I might just start accessing it for reasons that have no financial value. So you want to make sure that if you're using this to consolidate debt, using this to save money on something over time, or you're using it on something that will allow you to make money. And even in those scenarios, you want to make sure you do your research to make sure it's either a good investment or a good use of what you have at your disposal. That's it. S blocks can be really complicated if you're not familiar with the concepts of collateral, but I hope some of these examples broke it down in an easier to digest way of learning the concept. My name is Brenton Harrison, and if you like these videos, I really do hope that you subscribe to the notifications so that you know when new videos are coming, and we'll keep bringing them to you as soon as we can. Have a good one.